Hey, what's up, y'all? So I'm back. So we have gone over a few things, but we haven't gone over really the nuts and bolts of one of the things I love to do, and that is invest. Right. So when I was a sophomore in college, aka youngster year at the Naval Academy, I was messing my money over left and right. I think I mentioned this before. So I was trying to chase after the Joneses and follow after them, which I couldn't do. And it caught wind to one of my basketball coaches that I was messing over my money every month and I was using these credit cards to sort of make sure I was living like everybody else. Um, so the reality is he put an allotment on my account and made me live off of $50 a month. That absolutely sucked, to say the least. It was terrible. But what he did was he took that money and he started investing in index funds. Um, and then eventually I got access to my account and I could see the amount of money that was being gained because the stock market was doing okay at that point, right? And I sort of got addicted to it. Like, man, you're getting free money from just putting money up every month. And I was only putting up $50. The next year I increased it to 100. And then I got a couple bonuses and I made sure I put 30 to 40% of the bonus into that. So by the time a couple years out of undergrad at the Naval Academy, I had 50 grand saved up, right? And really it was because I just, every month I was buying. I didn't even know what I was buying. I just knew to buy it, right? And then I ran into a problem, right? So I had a brokerage called Primerica, which if you don't know about Primerica, it's it's really, I say it's a run-of-the-mill brokerage. So they were charging me some abnormally high fees. And the only reason why I figured this out is because I started looking at my statements and I was like, man, I'm really not gaining much money. I'm not building much money. And then I would try and buy more shares of the mutual funds I was in, and then come to find out the mutual funds are closed. And so then I started getting pissed off, and I'm like, man, I'm trying to invest my money, but they aren't really helping me. And then I didn't get any advice, right? My coach wasn't really my financial advisor. He just got me started. He was technically an advisor for Primerica, but he wasn't my financial advisor, right? The reality is I didn't, Primerica didn't want to pay attention to me because I didn't make a lot of money, right? And I didn't have that big of an account, so it wasn't that big of a deal. Majority of financial advisors, they start to salivate when they think when your account is above $100,000, right? And the reason why is it used to be very prevalent, this model of getting paid called assets under management. So the more assets, the higher your account is, the more the advisor gets paid. Now, advisors are supposed to have a fiduciary responsibility. Now, what that means is they're supposed to take your best interest in mind. Unfortunately, sometimes this doesn't happen, and you end up paying quite a bit, and you just don't realize it. There are tools like Personal Capital, which are actually really good about making sure that that you're paying low fees, right? And for me, I was an index fund investor, which I didn't know I was at the time, right? That paying low fees for something that takes minimal work should be pretty obvious, right? Like if I over a course of a year are making $100, but at the same time I have to pay 20 of those dollars to advisor who I never talk to, who doesn't help me at all in making my financial decisions. That seems just asinine to me. Why would I decide to give somebody money for not doing any work? Like, just not gonna happen, right? So I started to dive a little bit more deeper into it. So one of the first books that I read was The Intelligent Investor. Being a math sort of geek, math nerd, computer nerd, I thought that book was it was astronomically off the charts. It's the best book that you can read if you want to learn how to invest. The funny thing is, in Intelligent Investor, they say doctors are some of the worst investors out there, right? Because they overestimate how smart they are. So I'm always very cautious about overestimating anything, and I take the cautious approach, but I am pretty aggressive in how I invest. After reading that book, I was like, hey, let me try and put some of this to use, right? And that's what I teach people to do. And the reason why that book is so important, I didn't have really any real mentors or people to look up to growing up, but when I started investing, the person I looked up to was Warren Buffett. I'll never meet the guy. I just think he's a phenomenal investor, and I think his approach about money is very unique, and it's inspiring too, right? Um, Benjamin Graham, who wrote The Intelligent Investor, was Warren Buffett's sort of mentor. He taught him in business school, and I took that to heart. So I was like, if this person taught Warren Buffett, then I'm going to learn from this person. And the best way for me to learn from this person is to read his book. And so I digested everything in it. And I went over it a couple times. I read the book probably about 3 times now. And I still go over stuff, and I keep it next to my bedside just to remind myself of things, right? Um, One of the things is making sure, now granted, the Intelligent Investor was applicable largely back when companies were not overvalued like they are now, right? The whole thing is with the Intelligent Investor is to find good companies that pay dividends regularly, which is hard to do these days. And they have a long-standing history of paying dividends, again, hard to do these days. And they have to be priced at a discount, right? That the market has to believe that these companies are not worth as much as they are truly, right? And so in order to do that, you have to sort of do some math, which again, ding, 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 I'm a math geek and I like numbers and I like to analyze things. So to do that good, you really need to look at the balance sheet and the financial statements. So the Intelligent Investor was good for me because it led me down this rabbit hole to learn how to read balance sheets. And it led me down a rabbit hole to start looking at the company prospectus and the 10K filing from the SEC. One of the key statements in the 10K filing is actually to look and see what the management says about the company. There was one company I was looking at, I won't say what it is, it's flat out states the investor will lose money if they invest in our company. We do not plan on being profitable anytime soon. Like those are red flags, right? The reality is these days, like you have stuff like Robinhood, right? No commission trades, awesome. Charles Schwab, awesome, no commission trades. But the reality is the retail investor, meaning me and you, right? You got to do some research into how and why you should invest in a company. You got to remember, you're giving them your money for a fractional share or a share of ownership in that company. Now, granted, it may not be 10% ownership, which is needed to be on the board of any company, but I mean, it's ownership nonetheless. You're exchanging money for a piece of ownership in that company. You are a company owner, right? That's important, right? So the management should be working for you. If you're going to invest in somebody, you need to expect a return back. That's just a reality. So I'm an aggressive value sort of / growth investor. I look for companies that have high growth. I also look for companies that Warren Buffett always quotes about that have a moat, that have a unique economic advantage to their competitors. Now, I'm not being a surgeon, I'm not a huge fan of insurance companies, but the reality is they have a moat, right? Their whole business model is built upon collecting as much money as possible without paying it out. That actually does well for investors because guess what? They're going to have a large cash reserves or else they're going to be deemed a Ponzi scheme. So you really can't do that. But the reality is, as a surgeon, I'm like, if everybody who's insured under that company, if they all had a catastrophic illness or needed their premium paid out right then and there on the spot, then most insurance companies can't cover it. That's just a reality, right? Because the insurance companies, even though they have cash, they also invest that cash and they also loan that cash out. So their cash is usually tied up somewhere. It's not in like actual cash, right? But I digress. So I look for companies that have an economic advantage, a technological advantage. They are a market mover. But this requires me to also buy these companies on a discount, right? So what I mean by that is I don't want to pay what the market is saying. Like paying what the market says the company's worth, like you might be overpaying, right? The price to earnings ratio of the S&P 500 right now is between 15 and 18 on average, right? So that means below 15, the company is not valued as highly as the market is suggesting, right? And above 18 means that you're paying for more than what the market average is, right? So the reality is, no one wants to go. We all want to hook up, right? We all want to get something at a discount. We all want to not have to pay full price for things. That's just the reality of human nature. If we can buy it for cheaper and it's the same product, then we're buying it for cheaper, right? There's very few people who goes, oh, charge me 150% of what it's worth. Like, nobody wants to do that. Everybody wants to save money. We all want to save. We all want to be cheap. Well, you just don't know it yet. Pushing forward, if like some of the news talks about investing in Hertz right now, right? The reality is Hertz declared bankrupt, right? The COVID-19 completely decimated the rental car market, right? But people are still buying Hertz and propping up the stock. I don't get it, right? The stock is literally worth nothing. The company said we're going under, we can't survive, and people are still buying the stock thinking that they're going to make some money off of it. This is what I mean by the market doesn't reflect what the actual company is, right? So the market, you and I, institutional investors, retail investors, yada, yada, we determine what the market price is. It's the popularity contest, right? So one day, one company might be popular, the next day, another company might be popular. Those are companies that have high volatility swings, meaning they get traded a lot. The day traders like to go after them because there's some indicators there. Again, I'm not a day trader. I don't read candlesticks or anything like that. I prefer to take the long approach because my goal is to not sell any stock, right? Because I've made that mistake before, completely made that mistake before, and I kicked myself in the tail about it. I had going into residency, I had a couple, a little bit of a significant amount of stock and several real estate investment trusts, which I'm a big fan of because their business model states that 90% of the money that comes back to them has to be given out to investors. So ding, 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 it's easy to get dividends off of. So I like those stocks to provide me access into a real estate market and provide some additional income. Not that I take as income, but that I reinvest the dividends, right? So I can buy more shares to get more dividends to buy more shares. My goal is to be a forever investor, right? If I do things correctly, where I'm structurally sound with my financial plan, meaning my emergency fund, my long-term investment, meaning in the stock market and companies that I buy shares of, and my real estate investing, meaning with apartment buildings, rental properties, REITs as well, right? And then with my retirement, if I do that across the board, then I shouldn't have to access all of those things in order to provide the correct amount of money in retirement. Again, you have to make sure that you know what your number is. I know, and I put on my board what number I'm chasing, right? And I set the number twice as high because even if I don't make it to that number, I know I'm at least going to hit the number that is my bottom, right? The minimum number I want to get. And I'm not afraid to say that I'm trying to get to 20 million. The reason why is at that amount, man, that money, the compound interest alone causes it to snowball, and that will change generations. Imagine if your kids don't have to even touch that money, and it's earning a terrible interest rate or compound interest of 4% per year. Like the amount of money that just is gained over and over and over, it will change generations. It will change the trajectory of your family. So if you grew up poor, like you got to invest. It's just the reality, right? So to help everybody out, I created a spreadsheet a long time ago that I use to analyze balance sheets and to tell me at what the stock price is comparable to the levels that I want to purchase at, right? So if the stock prices were 50% or the true stock price, right, versus the current stock price. So I look and see, well, what is the true valuation or what I think based upon the market fundamentals and equations, which are readily out there, right? And you can look on YouTube on how to do this stuff, but I created a spreadsheet that all I have to do is put in a couple numbers and it takes care of the rest, and then it will flag particular companies that might be trading at values at a discount, right? but it's still on me. Even if I release, and I am going to release that to you guys for free. I'm going to put it up on the blog by the end of the week. You can go on there, you can look at the companies to see, and I'll put all the data up there. You can pull all of them off, right? But the reality is you still have to do the legwork to look at the balance sheet to see if the management team has a philosophy that you like, right? Because you just can't invest blindly. That's how you lose money, right? Investing can be a science, but it can also be gambling, right? We get a dopamine rush from investing that is sort of crazy, but it's the same dopamine rush and the same high that you get from winning money at a craps table. So just remember, if you do this scientifically and you have a system, right? People say they have a system gambling wise. Maybe they do. And there are professional poker players that do have a system, but majority of us don't have a system. So we need some rules set up to make sure that we do things, right? One of my check boxes is I sleep on financial decisions. If I go to bed at night and I'm pretty motivated about doing something financially, I wait till the next morning and see if I'm still motivated about it. If I am, then that means that idea is pretty sound, and then I do more research into it. I probably research stuff more than what I should, but the reality is I try not to make bad financial decisions, because bad financial decisions can set you back, but it doesn't knock you out, but it can definitely set you back, okay? So stay tuned to the blog, stay tuned to what we're doing. I got a lot of good information coming up for you. If you haven't checked out our latest blog post, it's not checkers, it's chess, right? Part 4, and then check out financial planning for real people. There's some added tools in there, including a compound interest calculator, so you can see how much money you need to save in order to meet your goal. I hope everybody's doing well. Talk to you later. Peace.